Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, January 30, 2023. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, check it out. The first thing on the docket is where the market went to last week. We'll circle back to that in a moment. Next thing on the docket is who was able to make money in the market today, whether from inside the numbers or the live room. We had a couple of nice trading opportunities. We'll go over those later. Then we're going to discuss all the stuff around the horn. We're going to discuss what's going on and what's on the radar screen / docket this week. We have an FOMC interest rate announcement on Wednesday. It's also called Kabuki theater, so we're kind of waiting on the Fed. They're pulling back the market a little bit. We're going to get into more of that activity. We've got a bucket full of earnings on the table this week. I'm not sure any one particular stock is going to move the market independent of the others, but certainly as a group, it's a market-moving event. And I believe we might have a phony jobs number on the docket later in the week. So there's a lot of stuff going on. Let's get into the daily chart and see what's jumping off the page at us. We were talking about a number of times 407.20 as A, where the market was going from a magnetic perspective, and B, where the market was likely to find overhead resistance into a zone between 407.20 and 408.35. Friday's high happened to be 408.16. I think that deserves two things. A, how do you like dem apples? And B, funny how that works. And yes, the lazy swing trader folks, while we didn't take a trade in the SPY itself, we took a trade in a particular stock that was meeting a number in an industry that was also essentially meeting its number. We're up on that trade nicely, nice head start. And certainly, by the way, just so you know, a lot of that was based on the fact that the SPY was getting to its number. Aside from the fact that they got to the 407.20, what else is jumping off the page? Well, where'd the market pull back to today? Let's start there. So in theory, she pulled right back to the most recent breakout area. Where'd she break out from? Right here. Market runs up, eats some time off the clock, has the same high or right around the same high 3 days in a row, shoots up for a couple of days, right back to where it ate time off the clock for 3 days in a row. That's pretty much what happened today. Big picture on the daily chart is she's above all the moving averages. The trend is your friend until she throws your shit out the window. We do have a convergence of moving averages coming up underneath price, 250 and 20 period moving average. Now here's the situation. They're going to move the market this week. It's a moving type of week. Earnings, Kabuki theater, I think there's a phony jobs number, all kinds of stuff, all kinds of excuses to move the tape. We'll talk about more of the stretched out possibilities in either direction tomorrow night before the Kabuki theater event. They're unlikely to get very far before Wednesday afternoon. By the way, where's the next breakout area? Where's the next area where they're going to come back to pay a visit because they broke out above it? Well, it's not that far from current price. So you have one breakout area here, another one just below it. There's some other stuff on other charts. They're running some tests at present, regardless of what it might look like from an intraday perspective. The weekly chart closed above our trend line last week. Now that doesn't by itself mean here comes new highs 3 weeks from next Wednesday. What it does mean is as long as the market stays above that trend line, coming back to run a test of it from the top side is normal garden variety market activity. But staying above the trend line is not a bear case, it's a bull case, at least until or unless they're back below the trend line. So from a near-term perspective, that's going to be our bull-bear benchmark for now. Monthly chart, they tried to run a test in the vicinity, or did run a test in the vicinity of the most recent breakdown candle high. It doesn't look like they'll close above that high by tomorrow, but you never know. Don't count them out. Food for thought in terms of the FOMC/Kabuki people. The market can move either way based on what the Fed does, doesn't do, says, or doesn't say. We're not going to project, we're not going to guess. But here's one thing that's kind of on my mind. Let's say, and we're not saying, let's just say if, the what ifs. Let's say if the Fed gives the market the impression that they're going to slow down the removal of liquidity from the market. That's the reason the main reason the market's going down in terms of liquidity versus no liquidity. Money sloshing around in the market, it's a risk-on scenario, and I'm talking about the bigger picture when they started pulling it out. We had inflation, they were wrong, all that stuff. So the market goes down all last year on the fact that the Fed was withdrawing liquidity. Well, let's say the market believes they're going to stop drawing liquidity from the market. I don't know what they're going to say. I'm just saying, what if? At any point, should the market believe that the Fed is really going to stop or be close to stopping drawing liquidity or withdrawing liquidity from the market, you could get another leg higher. You could get a squeeze operation take place. Food for thought. Put it on a sticky note. We don't know. It's something you have to have in the back of your mind. Let's talk about some numbers real quick. We're going to start with the early commentary. We'll run up and highlight the important things, where folks made money, in the live room and inside the numbers. Zero dark 30, we've got the makings of a pullback on our hand. Looks like the whole spike of 407 thing had some meaning. Well, obviously we know that it did. Funny how that works. See, this was always a funny how that works. We'll start with our bull pivot today. 403.15, and the bulls get in the business of bouncing the tape / staging a rally. 403.15 was our bull pivot. During the morning rush, they dipped below. They had a quick recovery. Buy the dip crowd was out in full force, just like they were last week. We're still, and this was the concept going in, we're still in a buy the dip environment until we're not. And at least from an intraday perspective, 403.15 was our place. We knew that if price was below, we have to start looking in the southern direction. If price stayed above, we look in the northern direction. That's the definition of a pivot. And then we have some other stuff. Pause the video, read the notes, go back to the chart, and double check the work. We're going to scroll up and highlight some other important points. So we have a setup. Starting at 9 o'clock, I put a pretty detailed setup on the board. What was it? Here's our setup. The pivot is just above 403. Therefore, and mind you, at this time when I wrote this, price was below the pivot. They opened the day below the pivot. Now watch this setup, the commentary, then what happened in the market at the open and what the commentary was around the open. Pay attention to this. This is really, really important. If the bulls can get price above and close candles above, meaning the pivot, they'll try and recapture 404.15 or so. And then there's a higher number later. So here's the deal. If price is below the pivot at the open, we're going to look for a place to buy, meaning buy the tape, buy the market, buy the S&P, any which way you want, for a run back to test the pivot. If they run up to the pivot, there could be a short on the board for traders willing to assume the risk up to a spike of 404. So we're looking at both sides. We don't know exactly how it's going to unfold yet, but here's the layout. We're trading around the pivot. You need to know the pivot. Under normal garden variety conditions, 403 give or take will be overhead resistance for at least a scalp with potential, as would 404.15 give or take. Quick chart flash, 404.15, they spiked it and had a nice decline back to where? Almost to run a test of the pivot. Again, you got it. Funny how that works. That's the scalp with potential at 404.15. You see where we're going with this already, don't you? Above 404.15, and the door opens for another leg higher. Where's the buy area, you ask? Remember, this is still at 9 o'clock in the morning, 30 minutes before the bell even rings. At this time, because they could have done anything at the opening bell, it's the morning rush routine, good participation in the market generally first thing in the morning. I was looking for a buy down at 401.30 to 401. And then you have a backup plan down closer to 400, and you'll see later on I actually have it at 400.35. Again, with the pictures, there's your 401, give or take. There's the bounce up to 401.79. So they gave you the scalp at minimum, but this is already late in the day. The room is closed. Any trader taking a trade this late in the day is assuming more risk than normal because you're running out of time on the clock. But the numbers work. Now, let's see what happens as we get closer to the opening bell. Creeping up to and around 403, give or take, changes the risk profile of the short, which they were doing at the time, which is why I posted this. If they came from afar, it's much better risk-reward profile. Still overhead resistance and all that, but the trade is no longer the same. 932 above 403.15, the door is open for the 404 and change. We already saw that, which is overhead resistance, and we already saw that. Now, just in case and to be in the know, if she gets above 404.15, door opens for the gap around 405.70. However, what you'll see here later is they're not going to get to 405.70. That was filling the gap left open Friday. They come up short. We have a 405 in between. Again, pause the video, read the notes, go back to the chart, and double check the work. Then we had a nice trade on GDS. We'll circle back to stocks on the move. Here you go, 955. We move up the support area a little bit. If below, the door opens back to 403. This is short-term stuff. But above 403.60, door is open for 405. That's not the gap, but it's a fat round number, and it's magnetic, and they draw price in. So this post is at 9:55. We'll call it 10 o'clock for argument's sake. Here's the candle ending 9:55. As long as they stay above 403.60, it opens the door for 405. High of day, 405.13. How you doing? 10:02 post, 405 is natural resistance and magnetic. 405.65 or so is the gap left open Friday. Buy the dip, large and in charge, and they were at the time. You get the point. Pause the video. Read the notes. Go back to the chart to double check the work. It's consistent. They're all the same throughout the morning session. Then we have an end of the day or end of the morning session / lunchtime schematic. You get the whole thing for the rest of the day. You've got the downside. You've got the upside. Door opens for the lower zone beginning at 401.25 down to 435. That's if they got below the low of day. There's your 435. Yeah. What's going on with stocks on the move today? The earnings releases will come fast and furious between tonight and tomorrow morning, but we had some on the board. Only one hit its entry objective, GDS. 23.32 after the haircut at the opening bell was the entry target. Low in the 940 candle, 23.32. Funny how that works. They gave you the base hit. They came back for a retest and took off for the rest of the day. Jordan got it in the live room. We had participation in the live room on this stock on the move, GDS, plus the SPY stuff. And by the way, now we're both moderating the room. I'm taking traders through the pre-market routine, the morning rush. Jordan will do some education. He jumps in when stocks on the move or anything else we're watching is coming into a price. It's a dual effort. It's better for everybody. It's working well thus far. Camp IWM, it's all the same market. They found overhead resistance up at the highs we were talking about in this neighborhood. They're pulling back. The big picture is that's all it is. Right now is a pullback. While above all the moving averages, the trend is your friend until she throws your shit. We know about that. S&P comes down, NASDAQ comes down, IWM comes down. It's all the same market. Not all to the same magnitude each and every day, but today the IWM was down just slightly more than the SPY, but nothing to mention, just around the same. So it's a down day, nothing more, nothing less. We're waiting on the Fed. Not exactly the same routine for the folks down at the transportation department, My second favorite market leading indicator against the IWM, which is number 1. However, this is my favorite, a number 1 canary in the coal mine. Are they just coming in to run a test of these moving averages, or being down double the amount of the S&P, are they trying to tell us something across the transport complex? Canary in the coal mine, put it on a sticky note. The Q people were down just about the same as the transports, give or take. They were down a lot more than the S&P. It was a risk-off type of situation. Big picture. They ran up to run a test of a former high. They spiked the high by a little bit. They closed below it on the week, above the 200-period moving average. Now they've pulled back a little bit. The big picture is that's not abnormal. That's garden variety market behavior. Just because they didn't blow through it and close above it on the first run doesn't mean anything. We're the umpire calling balls and strikes. XLF was down 11 cents, 1/3 of 1%. Anything wrong with the financials? Short answer is no. Above all the moving averages, the trend is your friend until you know what. So therefore, there's technically nothing wrong with the financials if the financials are not falling apart, nor will the overall major market fall apart. However, when we take a look over at Smashmouth, it was a down day, $6, but 2.5% plus. That's something to write down on a sticky note. The semiconductor space is a very good proxy for the tech space as a whole. So when they're leading to the downside or leading to the upside, we can put that on a sticky note. It's important. We have to make sure we're aware of it. How about gold? We had a couple of requests out there to cover gold, so let me do it with GLD. And here's where we are. So we've been long in the swing trading product in gold for a while. Not only GLD, but one of the gold mining companies. We had nice gains, risk-free opportunity, all that stuff. But what's the big picture in gold? Well, when you look at the weekly chart, they're coming up to this area of a big breakdown candle high up here. They haven't got there yet. We have another important pivot up here, and hold your horses, we're going to get back to that one in a moment. There was also a gap up here. So they fill the gap. Now they're pulling back from the gap, but not really pulling back away from the gap. They're eating time off the clock under the gap, building energy to make another push higher. To do what? To maybe run a test in the vicinity of the high, somewhere up here. 185 is a nice fat round number. We'll call it the vicinity of the big breakdown candle. If they fall away, our bogey is the breakup candle low under 175. So that's where we are at present. But wait, there's more. Here's a monthly chart. Now, by the way, we talked about this at the time. We talked about this at length. This was a breakout area. Okay, fair enough. Take that off the table because that's not where we are now. Look up at the top, and we have two important pivots. So whether they run a test of one or both, we know that this trend line connecting these two important pivots can be important. Maybe they spike in and go test the other one, meaning the one from all the way back in August of 2020. The high is 194.45. But up in that zone, either that or this one, which has a high of 193.30, up in that zone is in fact overhead resistance. And if they start pushing higher, it's going to draw price in. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.